In 2024, Americans wagered $3.2 billion on a single election through a crypto platform that didn't exist 5 years ago. By January 2026, they were trading $700 million daily on interest rates, wars, weather. The product is not gambling, it is the financialization of uncertainty itself.
Welcome. You're now entering the incentive layer.
Chapter 1. The Everything Market. To understand what changed, look at the legal architecture, not the technology. For most of American history, betting on events was illegal or tightly restricted. Nevada held a monopoly on sportsbooks. Election betting was banned. Financial speculation was confined to regulated exchanges with defined instruments, stocks, bonds, commodities. The line between investment and gambling was policed by regulators, and that policing determined where capital could flow. The shift began in 2018 when the Supreme Court struck down the federal sports betting ban. But the real transformation came when platforms challenged what an event contract actually is. Kalshi launched in 2021 as a federally regulated exchange under the Commodity Futures Trading Commission, or CFTC. By registering as a derivatives exchange rather than a gambling operator, Kalshi could operate in all 50 states at once, bypassing the patchwork of state gaming laws that restricted traditional sportsbooks. The CFTC, an agency designed to oversee corn futures and interest rate swaps, became the unlikely regulator of prediction markets. Here's how the mechanism works. Users trade contracts with each other, not against a house. A contract pays $1 if an event occurs, $0 if it doesn't. The price fluctuates based on supply and demand. If a will it rain tomorrow, contract trades at 70 cents, the market implies a 70% chance. The platform takes a small fee. The users provide liquidity and information. This structure changes participation. Traditional betting is binary, win or lose. Prediction markets allow continuous trading. Buy at 30 cents, sell at 60, never hold to resolution. Profit comes from predicting probability shifts, not just final outcomes. The growth was explosive. Kalshi processed $23.8 billion in 2025, up from roughly $2 billion in 2024, a growth rate exceeding 1,100%. December 2025 alone saw $6,538 billion. The platform went from niche experiment to liquidity hub, generating an estimated $260 million in annual revenue. But this is only what it looks like at first. The most surprising part comes next. The asset class expanded far beyond sports. By 2025, you could trade on Federal Reserve decisions, inflation prints, government shutdowns, corporate earnings, climate events, geopolitical conflicts. Polymarket offered markets on whether leaders would be removed from power, whether wars would begin, whether celebrities would attend political rallies. The breadth became the point. Prediction markets became a parallel information infrastructure. CNBC and CNN signed exclusive partnerships to integrate Kalshi feeds into broadcasts. Wall Street traders checked prediction markets before economic data releases. The price became the prediction, and the prediction became the narrative. This is where the main problem starts. When everything becomes tradable, the incentive to influence outcomes becomes financialized. In late 2024, a Polymarket user placed $32,000 on Venezuelan President Maduro's removal hours before U.S. forces captured him, collecting over $400,000. The account was created days earlier, made only Venezuela-related wagers, then was deleted. Odds moved from 6.5% to 11% before midnight, spiking before the public announcement. This is not a story about one lucky bettor. It is a structural vulnerability. When markets exist on events that can be influenced by those with advanced knowledge, the line between prediction and manipulation dissolves. Chapter 2. The Consolidation Play. Every new financial instrument follows a cycle. Innovation, expansion, consolidation, then either regulation or collapse. Prediction markets are in the consolidation phase, and the speed is remarkable. The sector has concentrated into two dominant players with over 97.5% market share. Kalshi holds the regulated, institutional pathway. Polymarket holds the permissionless global liquidity pool. Between them, they processed roughly $40 to $50 billion in annualized volume by early 2026. This concentration creates specific power. These platforms are no longer just venues for exchange. They are information aggregators with real-time data on collective expectations across every domain of public life. Their prices move markets. Their probabilities shape media coverage. Their trading patterns reveal what dispersed participants actually believe as opposed to what they say in polls. The incentive structure has attracted significant institutional capital. Kalshi raised over $2.8 billion between 2024 and 2026, reaching a $22 billion valuation. Investors include Paradigm, Sequoia, Andreessen Horowitz, ARK Invest, infrastructure capital betting on the financialization of uncertainty itself. Traditional sportsbooks have responded. DraftKings and FanDuel, which dominate the $30 billion sports betting market with an 85% combined share, face a competitor operating under different rules. Kalshi's federal regulation allows it to offer sports markets in states where DraftKings cannot operate, creating regulatory arbitrage that favors the prediction market model. Robinhood, the retail trading platform synonymous with meme stock mania, launched its prediction markets hub through Kalshi and saw it become the fastest-growing product line by revenue, with 11 billion contracts traded by over 1 million customers as of February 2026. The company then acquired a CFTC-licensed exchange and clearinghouse, transforming from distribution partner into direct competitor. If we remove all the complicated words, the system is simple. Capital flows toward platforms that turn any uncertain outcome into a tradable instrument. The regulatory distinction between derivative and wager determines which platforms scale. The separation between sports, politics, finance, and entertainment dissolves into a single liquid market for predictions. But this is where we need to check the numbers. Do these markets actually work as forecasting tools? The evidence is mixed. Academic analysis shows Kalshi prices are relatively accurate predictors, but display systematic favorite long-shot bias. Low probability contracts are overpriced, meaning bettors lose more than they should even after accounting for long odds. Contracts priced below 10 cents lose over 60% of their value on average. The average return across all Kalshi contracts is approximately negative 20%. This is not a bug. It is the economics of the market maker model. Platforms profit from volume, not accuracy. The more people trade, the more fees accumulate. The fact that most participants lose money does not destabilize the system, it sustains it. Chapter 3. Historical Echoes. To understand where this leads, look at what happens when financial innovation outpaces regulation. The history is not encouraging. In the 1920s, bucket shops proliferated across America. Storefront operations allowed ordinary people to speculate on stock prices without actually buying shares. Bet on whether a stock would rise or fall with a few dollars deposit. The shops didn't execute real trades, they simply took the other side of customer bets. When prices moved against the house, shops sometimes failed to pay out. When they moved in the house's favor, they collected immediately. The bucket shop phenomenon grew until an estimated 1 million Americans were active speculators. It collapsed in 1929, not because shops disappeared, but because the real stock market crashed and revealed that unregulated speculation had created systemic fragility. Subsequent regulations, the Securities Acts of 1933 and 1934, were designed to separate legitimate investment from gambling and ensure markets served capital formation rather than pure speculation. A closer parallel might be the derivatives markets of the early 2000s. Credit default swaps and collateralized debt obligations allowed investors to trade on the probability of mortgage defaults, initially praised for distributing risk and improving price discovery. When housing prices stopped rising, the derivatives didn't absorb the shock, they amplified it. Instruments designed for risk management became transmission mechanisms for systemic failure. Prediction markets are not yet at that scale. The $40 to $50 billion annualized volume is significant, but small compared to the $600 trillion global derivatives market of 2008. But the growth trajectory matters. If volume doubles annually, prediction markets reach derivative scale within a decade. The structural vulnerability is similar. Instruments designed to trade on uncertainty create their own form of uncertainty. When you can bet on whether the Federal Reserve will raise rates, you create a market that reacts to every speech, every data point, every rumor. The market becomes a source of volatility rather than a predictor of it. So why has this not collapsed yet? Because the integration is not yet complete. The CFTC and state gaming authorities are in active conflict over jurisdiction, with over 20 federal lawsuits pending and a potential Supreme Court showdown by 2027. The CFTC chairman defends prediction markets as legitimate economic functions while deploying AI-based monitoring to detect insider trading. The tension between growth and legitimacy remains unresolved, but the trend is clear. Each month, volume grows. Each quarter, new asset classes are added. Each scandal that does not trigger systemic collapse teaches the industry where boundaries currently lie. Chapter 4. The pipeline problem. Every financial system that grows rapidly faces the same question: where is the capital coming from, and where is it going? In prediction markets, capital comes from retail participants trading on phones and from institutional speculators seeking new returns in a low-yield environment. The destination is less clear. Unlike traditional markets where capital flows to productive enterprises, prediction markets are zero-sum. For every dollar won, a dollar is lost, minus platform fees. This creates a specific economic function. Prediction markets do not fund companies, build infrastructure, or create jobs. They redistribute existing wealth based on forecasting accuracy. They are allocatively neutral, but distributionally active. The traditional paths to wealth in America, home ownership, wage growth, savings accumulation, have become structurally constrained for younger generations. Home prices rose faster than incomes for decades. Real wages stagnated. The standard promise of economic advancement feels increasingly theoretical. Prediction markets offer something different: the possibility of non-linear returns through information advantage. Unlike traditional sports betting, which is pure chance, these markets reward being right about complex events. If you understand Federal Reserve policy better than the median trader, you can profit. If you have insight into political dynamics, you can monetize it. The market becomes a meritocratic arena where knowledge, not capital, determines success. At least that is the narrative. The reality is more complex. While some participants profit from genuine insight, the structure favors those with advantages not about understanding the world better. High-frequency traders exploit latency. Those with non-public information front-run events. The platforms themselves have visibility into order flow that individual participants lack. More importantly, the markets have become a destination for capital that might otherwise seek productive investment. When you trade on whether the Federal Reserve will raise rates, you are not just predicting policy. You are creating a financial instrument that extracts value from policy uncertainty without contributing to economic production. The $700 million daily volume record set in January 2026 is not just entertainment spending. It measures how much economic energy has been redirected from value creation to value prediction. The accuracy of the forecast has become more profitable than the event being forecasted. In simple terms, this is what is really happening. The prediction market sector grows not despite controversial markets, but because of them. Platforms offering the widest range of events attract the most liquidity. Liquidity attracts more participants. Participants generate more data. Data attracts institutional users. The cycle continues. Chapter 5. What happens next? Systems do not collapse because they are imperfect. They collapse because imperfections become uncorrectable. The question for prediction markets is whether current frictions are sufficient to maintain boundaries or whether financialization logic will dissolve them. There are three plausible paths. First, regulatory bifurcation. The CFTC succeeds in establishing federal preemption over state gambling laws, creating a unified national market for event contracts. This accelerates growth and consolidation. Kalshi and a few regulated competitors dominate, while unregulated platforms like Polymarket face increasing pressure. The market becomes more liquid, more institutional, more deeply integrated with traditional finance. Second, fragmentation. State regulators win jurisdictional battles, forcing prediction markets to operate under the same patchwork laws that constrain traditional sportsbooks. This slows growth but might preserve boundaries. Markets on elections and geopolitical events might be prohibited in some states, creating uneven access based on geography. Third, and perhaps most likely, a crisis of legitimacy followed by restructuring. A major scandal, evidence that a prediction market was manipulated to influence an election, or that insider trading on a war market affected military decisions, triggers rapid reconfiguration. Not an end to prediction markets, but forced separation of functions. Platforms might divest certain market categories. Real-time data sharing with media might be restricted. The integration built over 3 years could be partially dismantled. None of these outcomes is inevitable. Systems can persist with obvious contradictions for extended periods, but the trajectory is clear. The financialization of uncertainty expands, not contracts. The $40 to $50 billion annualized volume of 2025 is a baseline, not a ceiling. Industry projections suggest the sector could reach $95.5 billion by 2035. The deeper question is what this reveals about how we handle uncertainty as a society. Prediction markets offer a technological solution to dispersed information. They aggregate beliefs efficiently, but they also outsource judgment to price signals. They replace collective deliberation with individual speculation. They transform citizens into traders. The bucket shops of the 1920s were closed because they served no economic function beyond speculation. The derivatives of the 2000s were regulated because they threatened systemic stability. Prediction markets have not yet faced their reckoning, but history suggests it will come when the costs of financialization exceed the benefits of price discovery. Chapter 6. The Unresolved Exposure. The unresolved exposure is this. When the market becomes the primary lens for interpreting reality, we lose the capacity to distinguish between what can be priced and what should not be sold. The prediction market sector has built infrastructure that makes everything tradable, creating a system where the incentive to financialize uncertainty is stronger than the incentive to resolve it. The constraint is cultural. Not whether technology works or whether regulators can police it, but whether we can maintain categories of life that are not subject to speculation. When a war, an election, and a weather pattern are all equally tradable, the distinction between civic engagement and financial optimization collapses. What event do you see that should never become a market, and what would it take to keep it outside?